Shifting gears to the next phase, which is looking at the static tools that we have in our risk management toolkit. And how does one of our strategies, the systematic equity strategy, utilize some of these static tools to effectively manage risk?
Great. So what am I going? I'm basically going to talk about our systematic equity strategy and what are the key risks that we look to address in that strategy. And one of my favorites is the behavioral risk that is there to investing. It is an issue actually which was not talked about till I would say as late as 4-5 years back, right? Because investing was always assumed to be a science. You look at the valuation, you do a DCF. If it is cheap, you buy. If it is expensive, you sell, and that's how you make the returns. But of late, the nature of the markets have turned so much that I think behavioral biases, not only of investors, but also of fund managers, have a significant impact on the returns. In fact, one of my favorite books recently is a book by Robert Hagstrom, which says investing is the last liberal art, right? Investing as a liberal art, right? And a lot of tall names and stalwarts have written books like Adaptive Markets, Narrative Economics, and stuff like that. So what exactly is a behavioral bias or a behavioral risk in investing, right? So I would put it broadly into two buckets. One is an investor-led risk. So we all see the markets falling to 7,500. Everybody's talking about 6,000. We panic, we sell. We look at the market from 7,500 go to 12,000. No, it'll fall. It'll go to 12,500. And when it goes to 13,500, we buy, right? So those are investor-specific biases which have a significant impact on returns. And there is a recent study again done by Templeton, which says that most of the active investors in their funds make less return than the funds themselves. And the only guys who made better returns than the funds are the guys who are dead, right? So again, those are the biases of individual investors. Then we have biases which are linked to fund managers. And I would again put that into two buckets. One is basically people fall in love with stocks. This is a great company. It has delivered XYZ returns and the management is great. I will buy it irrespective of whatever. Or I don't like the management of this company. We're going to sell it. We don't have to have that in the portfolio. Blah, blah, blah. The second, on the fund manager side, is obviously a style bias. And we've seen that pretty clearly in the last few years. So you have certain fund managers who have a very quality bias. So they will buy quality at any price and will not go down, to the other stocks. And then there are, fund managers who have value bias. Then there are fund managers who will have small cap bias, small caps are. So those are the biases on the side of the fund managers, which can give you decent returns, maybe in a short span of time, but over a longer period of time may or may not perform. So what in systematic equity we try to do is try to take out these behavioral risks out of the process of investing, right? So basically we use multiple factors and try to build a portfolio. The challenge always in building such a portfolio is, it sounds very interesting, but the challenge always is there are more than 200, 300 actually factors in academic literature, and some of them call them a factor zoo, right? So which are the factors that you will take? Will you take quality? Will you take value? Which market will you take quality? Which market will you take value? And they have multiple definitions. So what definition of value will you take, right? Will you take the value definition, whether the company is high PE or low PE, whether it is high PE relative to the market, whether it is high relative to the sector, whether it is high relative to its own valuation? How do you define each of those, right? Because expensive can continue to be expensive for a very long period of time. And we've seen that in the market, right? Then what is the timing of the factor? Because the market also over the last at least decade or so has become very, very dynamic. So there's always a rotation, right? So people will suddenly switch to quality, will suddenly switch to value. There is momentum in the market. So which factor do you choose in different kind of markets? And then obviously with geography. So let's say it's very easy to talk about the US markets and we say, okay, value works, in a certain time frame, but value, the way it is defined in the US market, which is price to book, does not usually work in a market like India, because price to book tends to become a kind of a trap, right? A value trap. So what we basically try to do is try to look at, and we've studied all these 200-300 factors, we've given various definitions, and our belief is that we can broadly divide the entire factor zoo into three kind of factors, and those three factors, we believe, and actually academic literature also says, explain 95% of the returns of most of the active fund managers. So actually, factor exposure, even there are papers which say that factor exposure can explain 95% of Warren Buffett's returns as well, right? So what are these three factors? We look at basically quality, we look at size, we look at value, and we look at momentum, right? So, in very layman terms, what are these things? Basically, what we say is quality over a longer period of time tends to hold on to its own, because quality, as defined by the business, quality as defined by the management, right? The second is size. Obviously, size is something which is for the last, I would say, 2 years, not given great returns, but over a longer period of time, smaller companies tend to generate, because they have higher growth rates, and tend to generate. So if you get the right quality company, will typically have a better growth rate and would also be under analyzed for you to give a decent return. The third is obviously value. Now, you can't buy quality at any price and expect to make a return. And we've seen that enough and more in the Indian context. So we've seen, lever languishing for almost 10 years. We've seen the IT companies languishing for almost 4 to 5 years, and despite being very high quality. So basically, there is a certain time when you need to buy the stock, and there is a certain time when you need to sell the stock, irrespective of the quality. And finally, we look at momentum, because even if you have a great quality company which is reasonably valued, the market may or may not take notice of that. So by momentum, what we try to see is that we look at companies which fit our other parameters, like quality, value, and say that the market has eventually recognized that. Again, the case in point is, till the last quarter, a lot of auto companies and auto ancillary companies have, great quality management, great track record of delivering values, but the market had been ignoring them for a fairly long period of time. In the beginning, again, Naresh mentioned something like an ITC, right? So it's got superior return ratios, but has been languishing for a very long period of time. So if you're able to scientifically select, so in systematic, what we do is we scientifically to take all these factors, put allocations, put a certain weightage, and build the equity portfolio. And what this unbiased scientific approach to investing does, is create an equity portfolio which has, over the last almost 8 years now, delivered a performance which is almost 2.5 times the market, right? So by not letting your biases come into the decision-making process, you're able to deliver returns which are far superior to the market. So that is one risk that we try to address, which is the behavioral risk to investing. The other risk, which we also focus a lot on, is the market risk. So we, in addition to the long portfolio, have a hedging strategy where we hedge the portfolio. Now, it's pretty simple to say you hedge the portfolio, but pure hedging is very, very expensive. So what we do is we have an adaptive hedging process through which what we do is we kind of try to reduce the cost of hedging. Because today, if you look at even, if you buy a normal put on the market, an annualized cost will anywhere be between 8 to 10%. And Indian markets have not given you 8 to 10% return. So what are you going to make, right? So the whole idea is to reduce the cost of this hedging. So basically our endeavor is that we should be able to capture most of the upside through, when the markets are going up, although we pay a cost of hedging. But when the markets go down, we should not lose money. And now we have close to about 29 quarters of performance behind us, of which we've had about 20 quarters where the market was positive and about 9 quarters where the market was negative. In the 20 positive quarters, the average performance of the market was 6. The average performance of the hedged book was about 5%. But what really held us was when the markets were down, the average on those 9 quarters was about 5 to 5.5% down, whereas our book was slightly positive in those 9 quarters on an average basis. So I just wanted to touch upon these two large risks which we look at through our systematic investing program. We have a lot of other risks like illiquidity risk, corporate governance, which through the factors we're able to address. But this is something that I wanted to talk about.
So, so clearly, from the systematic equities, the timing, the notion of cycles, the idea of matching factors, understanding the signals that help us understand the changing dynamics of cycles and therefore which factors are most appropriate, are all very critical and elements that we've spoken of earlier. Some of the bias reduction ideas that were spoken of is really the equivalent of overlaying a scenario approach to helping to mitigate some of the gap risks or the timing risks that could take place where your factors are not in sync with the market phase. And again, we spoke about some of these cycle issues earlier on in the presentation, in the discussion. And so I feel like when we think about the dynamic and the static, these are really a toolbox. And in this toolbox, we have a number of tools. These tools can be appropriately applied by the fund managers, by the investment managers, in creative ways to optimize returns and preserve returns through various market conditions.